putting things together. So how close we are to a recession at the moment?
Well, that's $1 million question right now, but all signs are there that recession seems inevitable. The way central banks are, I would say, way behind the curve in terms of the inflation print. We feel that inflation is mostly, it's not the question of whether it will come or not, it's about when. In inflation, technically, as a technical recession, effectively, which means 2 quarters of negative growth, that is a high possibility. But a sustained recession wherein we have, from incomes falling down, high unemployment, I don't think we are close to that event. So technically, we may be close to recession, but I think market has mostly priced it in. And although we believe that interest rates will go up, recession and markets will be spooked a little more. So we are not close to the bottom, but at the same time, it won't be, when it happens, it won't be news anymore. For example, 51% of NASDAQ stocks are down over 50%, basically. 94% of Russell 2000 growth stocks are down minimum 20%. Now, this itself is an indicator of how markets are scared right now. U.S. Treasuries, which generally are an indication of the most safest asset class, the best credit risk, are down 23% year to date. So, and this is the biggest fall in U.S. Treasuries in the history of data being recorded since 1973. So, I think there is enough data to show that market is spooked. We've seen many recessions before, but possibly this is one of the fastest and the steepest rise in interest rates that the world will witness in few decades now, and we are almost at a 40-year inflection point of change in trend of the whole monetary system being changed. So I think the next decade will be very different from the previous few decades that we have seen.
Mm-hmm. So if we look to the numbers about how much money they have printed, the US and Fed and the Europe Central Bank, it's around 25% of the completely or total volume of amount of money which is in circulation at the moment. So I'm asking myself, what I have learned about a crisis from 2002, 2008. We had a big crisis 2020, but everyone was sitting at home with the mask, afraid about COVID, so no one had really recognized it. So Michael, what do you think? Did they learn something about this crisis, what we had before?
Well, we're going from one crisis to the other, right? So it's been crazy. We're going from COVID crisis to the Ukraine war crisis. So it gets very difficult to a certain extent to really say, is it a fundamental structural problem, or do we have certain, very unusual external factors right now which lead us to where we are? I think we will probably see that over the course of the next 6 to 8 months. I hope it's less of a structural problem than it is a temporary problem. But then again, you have some underlying indicators which indicate that it could very well be also a much wider problem than just going from one crisis to the other. Sure, I think leading with the Ukraine war, the energy crisis is fundamental. If you look at, especially now, if you look at Europe, gas prices hike in Europe and in the US, but we're just at the very beginning, I think. Winter is going to come, and where is Germany going to get its gas? They're firing up actually coal again. They're trying to fire up maybe nuclear. All of that's going to take some time as well too. So these times are very uncertain, and it's super hard to predict anything. But I think if I would just make a prediction for the next 6 months, I would agree. I think we haven't seen the bottom yet. And that goes across all asset classes. We're very much also into crypto and blockchain assets as well too, and it's a disaster.
Yeah.
At the moment, at least. So
I don't know. I have a question here. You are a crypto and DeFi specialist. So if I look markets like Turkey or Lebanon, who have a high inflation, who has a very weak fiat currency, you see a lot of these people are already invested in DeFi and in crypto products. How do you see the future then of crypto and DeFi products in the US and in the European market?
Yeah, I mean, we were always very bullish on the crypto market on a long-term basis. Maybe the focus is on subdivisions of what we know is the crypto market right now. So DeFi is a great space, I think, to be in, because it's not about investing in a single asset, and I'm sure you would appreciate this as well too. It's about every investment strategy should have a diversification in their investment strategy, right? So, and to an extent where you even can execute on a market neutral strategy, so you don't have to be worried about are the markets up or down, but you know that you can make, no matter if they're up or down, you know you can get to at least a certain yield.
I had the feeling over the last years that we had in Europe we had a deflation. What was obviously no deflation. It was a made deflation from the central bank, in my personal opinion. And on the other side, real estate prices, Bitcoin prices, they all increased like crazy. It seems to me that we had a kind of a separation between real assets, and the inflation was somehow included in real assets, and to the fiat currencies. How you can explain this?
It's a fantastic question. So I would say that the whole world economy and driven by the central banks, I would say experiment of QE in the last 20 odd years, divided the overall investment sphere in two aspects. One was the financial assets and financial economy, and one was the real economy, which is still continuing, by the way. So what was happening was, for whatever reason, whenever recession or crisis hit, politicians are not brave enough to take the tough decisions, especially in the good times when they're required to increase taxes, nobody's doing. So when the crisis hits, they don't have any tools remaining on the fiscal side. So since last 20 years, we've had 3 or 4 crises. And every time the burden falls on the central banks. So central banks have only 2 tools, couple of tools. Basically, they can manage the money supply and they can play with the interest rates. So they were going all out in managing that part, and which basically kind of alienated the real economy in some form. So when central banks reduce interest rates consistently, what it does is it inflates real assets. So everything real goes up, everything scarce goes up. And they were able to do this tremendously and stretch the system, because for the last 40 years, very interestingly, we've had 2 major primary trends which are there. One is massive technology advancements, and second is declining population growth. Both of them were driving inflation down. So at one end, so you have these 2 mega trends which are basically increasing productivity, reducing inflation, and that allowed these central banks to basically stimulate economy, raise money supply in a way to raise standard of living or protect the people per se from recessions. But there's always a limit to how much you can stretch the system. And I think this crisis, in a way, markets are now coming back and telling that enough is enough. So basically, increasing monetary supply by 40% in 2 years. 4x the amount of dollars printed in 100 years or printed in the last 10 years. So this is the massive amount of stimulus that we have seen. So basically, financial assets, anything digital, anything went up in crazy way, and real assets did not catch up. And now it's the reverse which is happening. So any slight hint of basically quantitative tightening that the Fed is doing, so real assets are coming back, like commodities, oil, and all of that, and all the financial assets are basically contracting. And that's the reason the amount of debt in the system, the amount of inflation, the quantitative easing that was done over the last 10-20 years is so big that that is why it is difficult to call a bottom to this market so quickly, because the signs are not. There's so many signs which are still yet to come, where we can say that this is over.
I mean, at the moment we have a similar situation in the US and in Europe. Let's say they all printed approximately 25% of new money 2021. But in the US, we had this already, I think it was in the 70s, end of 60s, they had very high inflation by 14%. Nowadays it's by between 8 and 10 officially. And the US Fed, they were very rigorous. They just increased the interest, I don't know, to 10% or something like this. Yeah. So, but does Europe has this, still this opportunity? Because the most of the European countries already like, I don't want to say bankruptcy, but they live over their life standards. So does European Central Bank still have this opportunity really to increase interests?
Well, if you say it will be difficult in Europe, European Central Bank is also sitting on $8.8 trillion of balance sheet. They've also doubled their balance sheet. Everybody has followed the Fed. Everybody has made the same mistakes. Euro area is different because there is, in a way, still a political disconnect between each country. Obviously, how Germany decides, how much fiscal room Germany gives, it all depends on that. The good side about this is that German economy per se is very less levered. So, as a percentage of debt, as a percentage of GDP, Germany sits in the 40s, I think mid 40s, versus overall Euro of mid 80s. So Germany has much more room to be fiscally more at ease, and even if the central bank does a quantitative easing, takes back the quantitative easing.
So my last question to both of you, at the last World Economic Forum in Davos, one of the main topic was how to storage value. So this was behind all the discussions, the big questions, and people spoke a bit, how can I store my values? So we have the different opinions. Michael, what is your opinion, how you would storage your values? Let's imagine you have a lot of them, so how you would storage them?
Well, I mean, probably right now I would try to get away from different kinds of currencies, definitely. That would be fiat currencies, that would be probably single cryptocurrencies as well, too. So I think what's left, I mean, I love the DeFi space. So, I think the DeFi space still provides a possibility to put your liquidity behind the firewall, execute a market neutral strategy. So no matter if the markets go up or down, and again, there's proof points of this, that you can still participate anywhere between 10 and 15% in the market, right? That is possible. So at the very moment, on a temporary basis, I'll probably would put my focus on this. Besides probably, maybe precious metals, so like gold or something like that. I think people are fleeing back into that as well too. Real estate, depending on the market, I think it's very overheated. It gets more and more overheated. If I look at markets like Miami, for example, it gets super overheated.
One should build a diversified portfolio. As he said, it's not one asset class, something you can choose. Eventually, if the recession, for example, recession chances increase, we expect the bonds to do better than equities. I think the first sign of how market perceives if it's a deep recession which is coming, then you will see bonds go up first and equities continue to fall, and that will be a good sign to park some money in fixed income after the fall, especially short duration bonds. Other than that, very specific real estate, high quality real estate, which is obviously scarce. Anything scarce is good. I would also say have a small percentage of your portfolio still in something like Bitcoin or something. Precious metals is a safe bet in the sense that if you're hedging against potential rise in interest rates, high inflation, silver and gold both seem okay in medium to long term. But again, no one asset class diversify across is the best way.
For me right now, I think it's a great opportunity if you can identify, because growth, as you said, will also be in the future driven mainly by technology in every aspect across every industry, no matter if it's in the automotive industry with e-cars, right? No matter if it's in the energy business with alternative energies, etc. So at the end of the day, I would focus also seeing to invest some money in new technologies which are then creating these jobs in the future. I think there's great opportunity, and there is probably a lot of gems right now which can be discovered where you're going to make a really nice upside if you are able to bet on the right ones.
I mean, I as a venture venture capitalist and venture builder. I couldn't agree more on this. Thank you very much for coming today. Thank you very much for joining it, and
thank you.
See you soon. Yeah, thank you.